So it looks like these job numbers that we've been getting for months were complete fiction, or at least the data was really fumbled. And now that the truth is coming out, Jerome Powell is likely going to need to fire up the money printer again. And for all you beautiful humans out there, for context, I am a pediatric nurse who works very closely with families. I also follow a lot of finance, business. I've built businesses, and I see the struggle through economic uncertainty. And I've been tracking these numbers because I know real people who have been out of work for a while, and we keep getting told everything is fine. But here's the thing, they knew the job market was collapsing months ago. They ultimately fumbled the bag on this data, and now they're gonna actually have to fix it by devaluing your money again. And today, I'm gonna show you exactly what happened, why it's about to get worse, and most importantly, how to protect yourself from their next round of wealth extraction. Now, of course, the July jobs report didn't just come in weak, it exposed months of fraudulent data, or like I said, rather just data that didn't make any sense. Because in May, they told us that the economy added 144,000 jobs, and the real number is 19,000. And in June, they claimed 147,000 new jobs, and reality is just 14,000. So combined, that is 258,000 phantom jobs that never existed. And this isn't a rounding error. This was the biggest 2-month revision since the 2008 financial crisis. And this isn't the first time. In 2024, they revised job numbers down by 1.5 million jobs. They've been doing this consistently by creating phantom jobs, then quietly erasing them months later when nobody's really paying attention. They literally erased 250,000 jobs from existence and hoped that you wouldn't notice. But this isn't just numbers on a spreadsheet. Real people are sharing that entire departments, like 500 jobs, are being shipped overseas to India for cheaper labor. Plumbers in Oregon are even saying commercial work is the worst that they've seen since 2016. Tech professionals that have years of experience, 13 years of experience, taking like 8 months or longer to find work. And I've seen comments about how 250,000 jobs down to 19,000 jobs, how that revision is even acceptable. I know it seems like total market manipulation, and they're absolutely right. July added only 73,000 jobs, well below the 80 to 100,000 that we needed just to keep up with the population growth. And I wouldn't be surprised if that 73,000 gets revised down to maybe even like negative numbers next month. And here's the thing. So the unemployment rate jumped from 4.1% to 4.2%. And if you exclude healthcare and government jobs, which pretty much accounted for almost all of July's gains, the private sector actually lost jobs. And I've seen data out there showing that we're not even in the single-digit percentage. No, we are at almost 25% for functionally unemployed in this country. And every recession starts exactly like this. It's not with the stock market crash, but with a spike in unemployment. And we are watching it happen right now. Now, Chair Powell is working from data that is being provided to him, so I will give him that. But the information being used needs to change because it's based on trends and an algorithm that is not even relevant to today's landscape. Because when Powell said this just a few weeks ago, the labor market is actually still quite solid, but honestly, that aged like milk in the sun. Because I have seen all kinds of stuff. Like I saw out there, repo companies are 7 months behind because there are so many cars to take back, but apparently everything is solid. The moment these real numbers came out, the odds of a September rate cut jumped from 41% to 87% overnight. And then of course they have shot up almost to 95%. And trading volume in the Fed funds futures, they tripled in a single day. Powell ended up having to paint himself into a corner here. He kept rates high based on these job numbers. Again, bad data. And now he's staring down the barrel of a recession that might, I think it's already started, but Trump is also in a position where reinflating these numbers is not ideal because he really wants those cuts. So the job numbers need to align with that sentiment. So they're both in a corner, but more on that in a second. But cutting rates won't be enough. The Fed has already started slowing down their quantitative tightening, which is just fancy talk for stopping their balance sheet reduction. But as that was supposed to start to fade, you know what's going to come next. Quantitative easing. So basically money printing, the exact same playbook that was used in 2008 and 2020. Here's Powell's nightmare scenario. He needs to cut rates because employment is collapsing, but he can't cut rates because tariffs are driving inflation higher. Core PCE inflation has been stuck at 2.8% for over a year, above their 2% target. And when they say inflation is 2.8%, that's their preferred measurement trick. Because real people, I've seen people talking about $40,000 cars that are now $55,000. We need to talk about that in another video. But somehow their math says that it's only 2.8% inflation. I mean, just look at groceries alone. So as I was saying before though, here's where it gets politically interesting. So Trump fired the Bureau of Labor and Statistics Commissioner over these mistakes. He has been pressuring Powell to cut rates for months. 2 Trump-appointed Fed governors are already dissenting for rate cuts. This isn't just about economics anymore, it's about political pressure overriding monetary policy. And when politics drives the Fed, you get the worst of both worlds: higher inflation and economic instability. And here's what makes September meeting crucial, because they're updating their forecast. So in June, they predicted only 2 more rate cuts for the rest of the year. If they cut in September and stick to that forecast, well, they'll have to cut again either in October or December. The money printer isn't just coming back, it's coming back fast. And here's where they're going to try to distract you from the incompetence with shiny objects. So Trump is actually floating rebate checks from tariff revenue, $600 per person, $2,400 for a family of 4, except it's not free. And it's really the money that you're going to either be paying if you haven't already been paying. So here's how this scam actually works. First, you pay higher prices on everything because tariffs are a sales tax on imports. Wine importers, as an example, paying 20% extra to get products through customs. That cost gets passed to you. And again, we're not talking about like the Amazons and the Walmarts that can absorb some of these tariffs. We're talking about the smaller mom and pop shops that you're buying from, and they're employing maybe some of your friends and neighbors. They cannot absorb these tariffs. Then after you've already paid these higher prices, they want to send you back a fraction of what they collected and call it a rebate. It's like charging you $10 extra for groceries, then handing you back $2 and expecting you to be grateful. But here's the disgusting part, because they have collected almost $30 billion in tariff revenue just in July. And of course, as we kind of look at the year, over $150 billion in the first half of 2025 alone. Meanwhile, Trump's tax bill is projected to add $3.4 trillion to the deficit over the next decade. They're actually taking your money today through higher prices, giving you back a tiny portion, and sticking you with the bill for the spending spree. It's literally like taking a cash advance out on your credit card to then make the minimum payment on that same card. You feel good for like a second, but then what you realize is that you're actually making your financial situation worse. When the recession hits, and based on these job numbers, I think we're already in this one, the Fed is going to have to do exactly what they did in 2008 and 2020 and fire up the printing presses. They'll call it quantitative easing or emergency liquidity measures, or whatever focus group term sounds less scary than money printing. But the result is the same. They'll create trillions of dollars out of thin air. But here's how that works. The Fed buys government bonds and mortgage-backed securities, pumping fresh money into the banks, but this floods the system with cash, pushes down interest rates, and theoretically will stimulate lending. But what really happens is that asset prices explode higher while your purchasing power gets destroyed. The wealthy who own assets will get richer. You who work for wages will definitely take the hit. So you can look at the patterns of Q1 after 2008, Q2 2010, Q3 in 2012, and then of course that COVID money explosion in 2020. Each time they promised it was temporary, and each time the wealth gap got wider. And each time they also told you that it was for your own good while they systematically destroyed the value of savings. And let's actually connect the dots on what's really happening here. This isn't just incompetence, this is economic warfare against the middle class. So the first step is they inflate asset bubbles with cheap money, making homes and stocks unaffordable to regular people. And then step 2 is keeping wages stagnant while costs skyrocket, forcing you to take on some debt. And step 3 is when the bubble starts to burst, well, they just fumble the bag on the data. And step 4 is when you can't hide it anymore, you print more money and you call it a stimulus. Step 5 is rinse and repeat until the middle class is completely hollowed out. They've been running this playbook for decades and it's working perfectly. And this isn't just about white collar jobs anymore. People are sharing out there that even the trades are getting hit. Intel, of course, laying teams off in Oregon, but construction is also slowing down because permit applications are being put on hold. And we've also heard this floated around as well. The top 10% of earners are keeping the entire economy afloat right now, while the bottom has been falling out. And the tariff rebate checks, well, this is just the latest distraction. You give people a few $100s while you steal thousands through inflation and asset price manipulation. This is a bifurcated economy. The wealthy get asset inflation while everyone else gets wage deflation. But I don't want to sit here and just complain, because I'm all for education and preparing ourselves for what is coming. When they start printing money again, and they will, you need to own assets that maintain value during currency debasement. The asset protection strategy that I'm recommending is, of course, as you've heard, index funds and dividend-paying stocks. They'll inflate with new money. Real estate, either directly or through real estate investment trusts. This will benefit from both inflation and money printing. Then, of course, there is that international exposure because you're diversifying away from dollar dependence. Small allocations to inflation hedges like gold, and as I said in another video, I started buying at $400 an ounce for exactly this scenario. And I know that I keep saying it's like this guy again, but seriously, build that emergency fund now before rates drop and inflation returns. Pay down variable rate debt before rates potentially spike again, and automate investments before you're tempted to spend rebate checks on consumption. Consider skill development in recessions. Valuable skills become recession-proof income. And I understand that the job market is a hot mess, but do not stop investing in yourself and building skills. Now, the political reality check is don't get distracted by rebate checks or stimulus theater. Focus on protecting your wealth from currency debasement. Remember, every dollar that they print makes your existing dollar worth less. Everything I've told you means nothing if you don't take action before the money printer starts again. So this week, emergency prep here. Move cash to high yield savings while rates are still elevated. Audit your debt. Anything that's variable rate needs addressing. Open investment accounts, whether it's Fidelity, Schwab, whatever your preference. Calculate your monthly expenses. You need to know what your baseline is. Now, of course, this month, start dollar cost averaging into broad market index funds. Also consider that real estate position there for inflation protection, and consider increasing 401k contributions if you can, and after exhausting your Roth IRA contributions before rates drop. And definitely do some research on some international diversification here. Now, this quarter, this is longer term protection, 3 to 6 month emergency fund before money gets cheaper. Consider fixed rate debt for major purchases if rates do drop. Position yourself for asset inflation with real investments and develop recession-resistant income streams. Every day that you wait is another day that they're positioning to extract wealth from you. I have said this before. The money printing is coming. The question is whether you'll be ready. The market has seemed to have spoken in almost a 95% chance of a September rate cut, but remember, these are the same markets that missed every recession, every bubble, every crash, and they're betting on Powell caving to pressure and not on sound economic policy. But here's what they can't control: your ability to see through their games and position yourself accordingly. While millions get excited about $600 checks, smart money is positioning for asset inflation that is coming. While people celebrate stimulus, wealth builders are buying inflation hedges. Every step toward financial independence is an act of rebellion against their extraction system. The jobs report has exposed the grift. The money printing that they're planning will expose their desperation. Do not let them win. I would love to know what your next move is. Please drop a comment and tell me how you're positioning for what is coming. I will see you right back here on your next level up.